The Footprint course, Unit 14, the Delta Position Unwind. This is challenge day 26 of 30. In the following slide, we are going to focus on some of the key rules to understand about the financial markets, including the key participants, the objective of these participants, the skills required to be successful as a trader, and some of these skills and processes that various traders have.
First, most important thing to understand is who are you playing against? Who are the players in this game, or in this game of trading? Now, there's a number of different players, and I've kind of summarized them into 5. So the first and the biggest players being your pension funds, your hedge funds, your institutions, your banks. These are what we call influential players. In other words, they can move price around based on the decisions that they make. Okay, now none of us, not myself included, none of us are influential in the market that we can actually manipulate, or not manipulate, but maneuver prices and actually make price go up and down. So straight away, you've got to say to yourself, well, I'm not an influential player. The next type of player is a speculative player. Now, again, a speculative player in this definition, we try and include or more lean towards again influential type players. In other words, we're looking at hedge funds that are taking a directional view on whatever market it may be, and they either get stopped out or they don't. They're not holding that that product or that asset class until maturity or something like that. So the next type of player is a speculative player. Again, that does not include us as a retail market, as day traders, as short-term traders. We then have the high frequency traders. Now, again, this might include some of you that have developed algorithms. This includes you. The important thing to understand with regards to the players that play in the high frequency is they develop strategies that, one, are very exact, and two, have very specific both risk and reward. And we'll talk a little bit about that later when we go into actually some strategy development. Then we have the day trader. That's myself, your prop traders, your professional traders, as well as many of you. You would fall into this bracket of day traders. And then obviously swing traders. Now, the main difference between a day trader and a swing trader is merely the time frame over which we're holding. Day traders a little bit more short term, swing trader a little bit more longer term. Now, it's important to understand these players, because if you know which player you are and who you're up against, straight away, you're almost going to put yourself in a division of the players. You're going to say, well, I'm one of these players, therefore, this is the type of, not just objective, the skills and the process, but this is ultimately the direction or the path that I need to go down. Now, if you are a day trader or a swing trader, right, I'm going to outline for you now, firstly, what is your objective? Secondly, what are the skills you need? And then third, what is the process? And that's where the meat of tonight's whole Periscope is going to be. So your objective as a day trader / swing trader, first and foremost, is to develop consistency. Now, what you need to say to yourself when you go through your strategies, when you do your debriefs in the day, when you're thinking of great new ideas, you need to ask yourself, well, firstly, I am a day trader or a swing trader. Secondly, what I'm doing right now, this hour I'm spending doing whatever I may be doing, is that ultimately going to get me toward that objective of consistency? Okay, now the perfect example I like to use is sometimes someone will send me a long time frame day chart, and they'll say, well, what do you think about holding this for the next 3 weeks, for a 10% gain? And I'll say, okay, well, hang on a sec. Are you a influential player? Are you a speculative player? Are you, able to sit with a massive capital position for a number of days? And the simple answer for 99% of us is no. Okay, so in order to develop consistency, you're going to be needing to trade more frequently. Okay, and in order to trade more frequently, you cannot be taking 1 or 2 or 3 or monthly type trades. Okay, so you see how we outline the players to the objective. Then the risk management of all of these different players varies very differently. So An influential player or a speculative player, they can sit with massively wide stops. We're talking 4, 5, 10% stops. They'll hedge most of those strategies. They have very, very different risk management approach to what we do as day traders and swing traders and even high frequency traders. Okay, of all 5 of the players, high frequency traders have got the most unique risk management system in that they take very small losers all the time, but when they make money, they're actually making a lot more than what they're losing. Okay, then our next objective is to print green every single day. Okay, now that objective differs. If you're a swing trader, it might be okay to have a few drawdowns for Monday, Tuesday, Wednesday, so long as Thursday, Friday, when you do go on side or make money, it makes back all of those losses. Okay, and then the last objective is leverage. All right, influential players don't tend to use as much leverage as what we do as day traders and swing traders. Again, high frequency traders have a very different objective when it comes to leverage that we do as day traders and swing traders. Okay, so it's so important to understand, number one, what player are you? Okay, based on that player, what is your objective? All right, once you know what your objective is, then it's very simple to determine what are the skills that you're going to need to learn to develop in order to get towards your objective. So the first is consistency. Okay, now this consistency skill you're not going to develop by chopping and changing your strategies, by looking at various different markets, by trading futures one day, then trading equities, by following some guy on Twitter and taking whatever trades he spins out. You're not going to develop consistency if you're going and taking this approach. Okay, the next sorry guys, I actually don't think I've filled in the skills here. Okay, I'm going to give you the skills because I've written them down. So the first is consistency, the second is discipline. Okay, now again, with regards to discipline, how are you going to develop discipline? Well, the only way to develop discipline is to be in a number of different situations over different periods of time, different times of day, different days of the week. That's the only way you're going to learn to develop discipline. Now again, if you're sitting in trades and only doing one trade a day, are you going to develop discipline as a day trader / swing trader? Probably not. All right. The next skill you need to develop is patience. Okay. Again, how are you going to develop patience? Well, you're not going to develop patience by putting in a trade in the market and then putting in a stop and putting in a target and never watching it. Right? Because ultimately, by watching it, you're going to learn and take away a lot of information, from the market. And then finally, the last skill that you're going to need to develop is a little bit of, what I like to call good old-fashioned, pain threshold or real determination and grit. And again, the only way you're going to learn to develop this, the only way you're going to get through the hard knocks is by ultimately, doing a lot of trading, going through those trades, really just trying to, develop yourself through the hard knocks. Okay, so once we have developed firstly the players, we understand the players of the market, then we determine what our objective is as based on the player we are, as well as the skills we need in order to achieve that objective. We then go to the process. Okay, now the process is very simple, and I want you to write this down and think about it over the period of the week. Firstly, what are your strengths and weaknesses as a trader? Okay, straight away, you should be able to outline, well, I'm really, really good trading volatile markets. I really like it when the markets are fast, there's breakouts, there's a lot of clean breaks, the market's moving aggressively. I really like that. And you write it down as a strength. You then do the same and you write down what are your weaknesses as a trader. Okay, if you're very bad at risk management or you're really bad at being disciplined to stick through the trade until it's achieved what it should, then you write that down. Okay, again, the reason is you will start to develop strategy based on your strengths and not your weaknesses. All right, there is 0 point in trying to be a breakout trader if you suck at breakouts. All right, there's just no point. All right. Now, when I get to the pattern recognition part, I'm going to show you how this all molds together. Then, where do you fit in? In other words, where do you fit in into this whole entire market? Are you a trader that scalps? Are you a trader that likes to sit for a couple of hours on a trade? What kind of trades do you like to do? Where do you like, where do you feel most comfortable? Do you prefer the market coming to you and you getting passively in the market? Or do you prefer to be aggressive and provide liquidity to the market?
Hopefully that mentored session really drove home, the understanding behind the different participants and why it's so important to know who you're actually interacting with in the market and who's ultimately creating which strategy. It is obviously quite an important part of our template as it is a very, very important principle to identifying when a trade strategy will have a higher probability of success or lower probability of success. Now in the next strategy, this is obviously a counter trend strategy again. In terms of it's no longer standalone. This is the third of our context and footprint strategies, and obviously it requires a very aggressive execution methodology. So this is a little bit of a patient man's strategy. This does require a lot of patience. It's one of those strategies that you won't necessarily always see. A lot of the time you'll see it maybe at the end of the day, you'll be like, oh, there was that strategy again. In terms of that, obviously, some of the principles we're going to focus on you can see within the slide. But some of the key real focus points here are going to be the understanding of the delta, and the delta, the cumulative delta, as well as the shading around that delta and the unwind of that delta. Now, we're obviously going to move a little bit deeper into, positioning and pocket positioning of the delta, as well as liquidity, and we're then definitely going to pay attention to the end where we introduce our color lines, so that we make sure that when we have what we call a line in the sand, we can very easily identify it with a nice red color line. Alright guys, let's move on to the practical example now. Hopefully you enjoy this. This is one of the strategies I learned through a number of failures, so hopefully you can learn from the strategy and adopt accordingly. Alright, so Unit 14, Footprint Delta Position Unwind Strategy. Now, before we get started, let's talk about this idea of rules. Now, my honest belief is that rules are there to govern and provide structure. Okay. However, that being said, no great inventions, no great thought, no great breakthroughs happened without a little bit of bending of the rules. Now that being said, what most traders fail to understand is they tend to ignore the rules altogether. Okay, so just like any game, which trading is, just like any game, there's a set of governing rules. Example, being capitalized. Okay, there's a very, very good reason why you have got to be capitalized. Okay, now that reason stems from the fact that, like I've mentioned to you over the last couple of units, this entire job is about trial and error. Okay, now guess what? Trial and error is synonymous for failure. And all things being equal, failure should imply a loss in trading. So if you're insufficiently capitalized, one, you're not going to follow the rule and the process of trial and error, which means ultimately you're going to fail. Okay, so that's one of the rules, being well capitalized. Now, traders, for some odd reason, and again, I think it's because of the real speculative, lucrative nature of trading, there's still really this belief in the financial markets that you can get rich quickly. Okay, unfortunately, you could. I firmly believe the game was very different 20 years ago, but then the game was very different 20 years ago in, say, for instance, the property market. Okay, you could get rich buying property 20 years ago. Okay, equally, you could have got rich buying Bitcoin this year. Alright, so the rules change. And that's the important thing to understand. You have to be willing to adopt the rules that govern the game you're playing. If you don't adopt those rules, okay, you're ultimately headed for some sort of a run out of the markets. Now, note, once you do have the structure, which is what the rules ultimately create, only then do you begin the process of bending them. Why? Because through bending them, you're going to create edges. Okay, dynamic edges. Edges that no one else has created. Because guess what? Not many people are willing to bend those rules. Okay. Now, the next thing to pay attention to is this concept of a footprint delta position unwind. So it's very simple. Okay, I'm going to illustrate it for you. And you'll go straight away, you'll be like, ah, I've seen that before. So all it is a market moves up or a market moves down. The up move creates a bias, or the down move creates a bias. Now that bias, okay, the bias can come from two factors. One can be technical, okay, and one can be fundamental. And I'm going to go through some of the biases that can be created with both of these. Now, when there's biases in the market, the most important thing to note is a bias equals a cumulative delta. And this is the one trade strategy, or one of the few trade strategies where the cumulative delta is very, very important. Okay, so in essence, we lean on the cumulative delta to recognize the fact that there is a natural bias in the market as a result of either technical implications or fundamental implications. Now, what happens is the market begins the process of turning back around. Okay, we're not too concerned about how it turns around, why it turns around, etc., etc. We just acknowledge the fact that the market turns around. It then reaches a point, okay, which we are going to give a red line to. Okay, a red line, as we mentioned in the color line section of Unit 3, that is a key observation or a key price. Okay, we're going to call this line in the sand. In other words, this is a price in which the market should not really be getting beyond with the cumulative delta in place. So it's a place or a price in the market where we're likely to see an unwind of the bias. Now, how this trade actually came about was it came about through fading these things. So what would end up happening? We'd get to this line in the sand. What typically happens is you'll get a lot of two-way trade around that line in the sand, a last bit of defense. Once we take it out, you get the straight line washout. Now, I used to be the one buying it there, buying it there, buying it there, selling it there. And you can ultimately guess what the result of that was. So through time, I began to recognize a reason as to why the markets create these one-directional moves. Okay, as a result, I put the red line in place. The red line is a rule. Okay, and that rule says there's no trade opportunity. Okay, that's all it is. It's a rules-based approach. I've created a rule that gives me structure. And guess what? My consistency, my profitability on this trade setup went through the roof. Okay, I stopped losing money. I stopped blowing out on silly moves like that. The next step then was I went to bend the rule a little bit. And I said, okay, well, hang on a sec. I might not be taking a trade because there's no trade opportunity, but the market's still doing that straight line washdown. Okay, so I bent the rule and I said, well, surely there's a tradable opportunity to be a seller for the washdown. So I developed an approach, which I'm going to show you, to ultimately profiting whilst others are not willing to have a rule in place. And that's the purpose of rules, guys. The rules are there to govern us, they're to provide structure and protect us so that we can, do lots of trial and error, so we can fail a lot more in the future, but ultimately keep learning the lessons. So let's come back to this example now. So the basic premise, we have a bias in the market. We note that bias, that line in the sand. Now note, we will know that line in the sand through a number of factors, and they can include, let's just write a few of them down. In fact, let's go one step back. Let's go through some of the technical reasons as well as fundamental reasons for a bias. Now, the first technical reason will include maybe a breakout. Okay, so we have a key breakout of a level. Naturally, that puts a bias in the market. Why? Because all participants are in agreement. Okay, so there's a natural bias as well as a very strong delta. The next is a trending day. You see it so often on trending days. Okay, so we have a nice trending day. We spoke about trend. We said ultimately if we get the trend, lots of low volume areas, lots of imbalances in the market, and ultimately sometimes we get a straight line reversal. Why? Because when it turns, no one is willing to sell it, everyone is willing to buy it on the way back down. Okay, the next reason for technical biases will include potential low volume areas. Okay, so like we've spoken about, low volume areas or imbalances do show us, they do signal a form of initiative or strength or bias in the market. So again, when we take those up, we tend to get follow through. And the last is initiative drives. Okay, we spoke about initiative drives in one of the previous units. Cash drive open, pullback, and extension. Now, some of the fundamental reasons why we would get a bias in the market. There could be some news. Okay, some market moving fundamentals. Maybe something that's related to geographics, maybe the oil market, OPEC, etc., etc. Or we have some key central bank decisions, interest rate policy shifts or hawkish dovish shifts, as well as economic data, or at least key economic data. Okay, so these are the three fundamentals that can ultimately create some form of a bias in the market. Now, the most important thing we need to determine, and these are the key elements, is you have to learn ultimately what is delta. Okay, the entire trade strategy is based on the cum delta or the cumulative delta. So you need to learn what is above average. Okay, so what is above average cum delta? And this is going to vary from market to market. Okay, it's going to vary from time to time. So what I like to do, I've got a spreadsheet at the end of every day. I simply update the spreadsheet. Okay, you keep a total or a running total of the delta at the end of every day. You view it every day, at the end of the week, once a month. You're very going to quickly learn when there's a really big shift in the delta. Okay, now one of the important things to also understand is market context. What I mean by that is simply, traditionally, these biases you will see a lot better in a form of imbalanced markets. Why? Because imbalanced markets are likely to bring in more technical biases. Okay, so if we're trading at the extreme of a day and we break out, we extend, trade up to prices we haven't traded at in a number of days, it will tend to bring in some form of a technical bias. Now, in terms of obviously the volatility around this trade, okay, we're not too interested in the first section. Okay, we're not interested too much in what's creating the drive up. We simply are interested in the fact that the market's driven up quite aggressively. It's shown us the initiative through the likes of maybe some single prints, maybe some really one-directional trade. But ultimately, we then get the market returning to the key line in the sand. Now, we spoke about those line in the sands. And in fact, sorry, we haven't spoken about those lines in the sand. So let's mention them now. Now, some lines in the sand that you can expect to see, or where you're going to place this red line. First and foremost is the previous day's high and low. Okay, so let's say, obviously, this trade strategy broke out to the previous day's high and low. It extended. That previous day's high and low becomes a line in the sand. Why? Because ultimately, everyone long will be long until we re-enter that range. Okay, now, the next big important factor or potential for a line in the sand is a set of single prints. And again, this is very much a profiling term. So if you are more of a profile guru, or if you want more information about Axia's course on the market profile, you can obviously email us. But obviously single prints do represent for us, if I just illustrate it, if this is our set of singles, and then we have a whole sdistribution, that set of singles does represent a line in the sand. If we take that out, we do tend to stop down. The next one is obviously, I'm just going to make this a bit tidier, guys. The next one is obviously absorption in the initiative drive. Okay, so this is more pocket positioning. So if we see a market trending and absorbing, pocket positioning, trending, pocket positioning, okay, wherever that pocket positioning occurs, right, that is ultimately the positioning. That's the what we call the accumulation and distribution. Okay, so this is where the positioning took place. So whilst that will initially act as a form of support, once it does get back below it, there's obviously a lot of positions that need to unwind. The last one, obviously, or the second to last one, will be the starting price of a move. Okay, and this tends to occur quite a lot with economic data or maybe news, etc. So when we return back to the starting price, so let's say again, if I was to illustrate, market moves aggressively higher, that's our starting price. We do all sorts of crazy things in between. Once we return to that starting price, that becomes our red line line in the sand. And then our last is, again, a little bit of a profiling term, is the 50% of the day. Now again, like I said to the previous unit, this is not an exhaustive list, okay? And you should not see this as the only ways of identifying a line in the sand, okay? How you're going to learn this trade strategy is you've got to start off with step 1, okay? So let's go through this again step for step. We identify the bias. We identify the bias with the aggressive cumulative delta. Okay, that's how we identify it. Note, we also want to identify it with some form of strength showing us that bias. Okay, so that can be imbalances, it could be maybe single prints, it could be low volume areas, okay, it could be shallow distribution. So some form of trend we want to see in the market that signals and identifies that bias. Once the market returns to that red line that we've created, which we've obviously now identified a number of ways we can identify it. Once we return to that line, we are then potentially in play. Now I'm going to zoom in here and I'm going to show you how the strategy works. So it's very simple. What will tend to happen around this line in the sand, and this is a wonderfully intricate strategy, and the tip I'm going to give you for this trade strategy is always know the market positioning as it shows the market's short-term bias. In other words, if you know what this cumulative delta is at any point, whether it's over the day, the week, the couple of weeks, right, you've got a very powerful piece of information, okay, because you have a good understanding of, who's more aggressive between buyers and sellers versus which way is price ultimately going. Okay, so ultimately, when we return back to that price point, what you're going to see is our last stand of defense. Now, the reason this trade works well and why we get a good opportunity to enter is that the market will come back to this red line in the sand and it'll pause. Okay, so you always tend to get a little bit of a mess around this line in the sand. So it always messes around you the first time. And the mistake a lot of people make is they're ultimately buyers, okay, at this area. Why? Well, because there's a bias in the market. It's pulled back and given them a chance to be long. Okay, so people step in and they buy. But what happens is as they're buying, the market is struggling to maintain a bid. Okay, and ultimately what's happening is someone sitting on the other side and passively absorbing the buying. Once we then take out that lower pivot, that's the point in which we want to execute. So we want to see some form of sideways distribution just before the break. Once we have the break, or we see a little bit of absorption just before the break from the sellers in this example, we then execute with a relatively tight stop, looking for the unwind of the delta. Now, stop is very, very simple, above the top of the distribution. Target's very, very simple. We want to see that delta return back to neutral, or, as a rule of thumb, potentially extend the low of the day. Once it does that, it enters a period of exhaustion and will likely take a break. So we either look for an unwind of the delta or an extension of the low. Okay, and that's pretty much how the trade strategy works. That's the basic premise of the trade strategy of a position, a delta position unwind. Now, let's look at some of the charts, and you'll get a little bit of a better understanding of what it looks like on the footprint. Now, again, what we can see, this is the pound against the dollar, 12th of December, 5-minute rotations. Again, you can use either rotational or time-based here, or even imbalanced. You will see it equally well on all three. Remember, the most important thing we're paying attention to is the delta. Okay, now, like I said, you need to know your market, you need to know what a big delta is. Now, this is going to go contrary to what I'm going to say, but this isn't really necessarily a large delta. Okay, not for the pound. I'd say a large delta for the pound, you're looking somewhere around 1.5 to 2,000 contracts. But it is a relatively good example of a delta unwind. So I'm just going to go through it with you. But bear in mind, you do get better examples with much higher cumulative deltas. Now, also note, you don't necessarily have to go from a high delta. So you could have maybe positive 400 delta, and when it unwinds, it goes to maybe minus 3,000 delta. Okay. So ultimately, what you do want to see, remember the delta can be slightly misleading. In other words, as we're coming up here, we could be seeing more selling than buying, even though prices are rising. Hence why we're not seeing the delta pick up aggressively. Okay, so again, like I said, the cumulative delta is important, but it's not necessarily the be-all and end-all. And again, if you observe this pattern within your templates time and time again, you're going to see what works better than not. Now, note the initiative being taken. We can see the one directional Note the imbalances, light colors. Again, a little bit of dark responsive, some stop up. Okay, some really aggressive price response. Market gets up to the top. You see a little bit of response. Now, we've got our line in the sand. Okay, this is a line in the sand. This was over a data piece. Okay, this is where the data started. So we're looking at drawing a red line. This is our line in the sand, as this is where the data point began. Ultimately, sorry, this is not where the positioning began. It began on this line. Okay, that's where the data came out. We can see the market moved higher, a little bit of absorption, moved higher again, quite a lot of absorption. Okay, so we're not interested in this first part. That's all data related. We're not really interested. What we are interested is if the market does move back to this red line, which we've created, we are interested in a potential unwind of the delta. Now we can see that delta gets all the way up to 615. Market comes back, we see a little bit of accumulation. Then we start to see a little bit of imbalance on the sell side. Market comes back to test that line. It very briefly sits below the line. Okay, so like I said to you previously, what you will tend to see is the market sit on both sides of the line and trade it out. It tried to do this. Okay, so we can see very briefly it did try and fill this out, but ultimately it happened so quickly. I think we only traded, as we can see there, we only traded 920 contracts in that entire rotation before the market began the process of moving lower. Okay, so ideally this is where we would have executed, in and around that area. Obviously we'll be selling on the break of that low, looking for an extension, stop above the absorption zone, profit once the market ultimately takes out the delta or extends upon the low. Okay, that's our first example. So our second example we're going to look at is the WTI oil, 20th of December 2017. What we can see, obviously, a really high volume surge here. Market has an aggressive down move, quite an aggressive delta, a real technical bias in the market, and a real key line in the sand posted. Now note, the market obviously begins the process of auctioning below that line in the sand, so we're not too interested necessarily at this moment. However, once we get back below those key pivots, we can see the market does provide us with a potential for buy opportunities for the delta unwind. We can see that delta obviously shifts from all the way minus 1,300 all the way to positive 1,044, before then again extending higher to 2,373. Okay, so those are two static examples. Let's now go and have a look at one of the videos. Our first video we're going to take a look at is the euro dollar, and again this is the positioning unwind. So I'm going to fast forward this for you, show you what it obviously looks like on a chart, the initiative. So we can see obviously the market on the candlestick, best place to look. We can see a little bit of sell-off coming in the market, and market sells, a little bit of a wash down, a couple of stops, nice imbalance there. Market tries to go back bid, and I'm just going to move a little bit further on to the point where we're about to get some form of an unwind. Now again, obviously you can watch this video through from start to finish, apologies, but ultimately if we just pause here for a second. Okay, so we can see in terms of context, the market in terms of volume, we've seen a real pickup in volume here, real dark shades on this 5-minute rotation. Note the cumulative delta, okay, really negative. This is quite negative for the euro, minus 1,000. Ultimately, our line in the sand, we can see market sold off, pulled back to this area. You can see it rejected once, twice, 3 times. And once we took it out, let's just go back a few frames. So once we take out this little area here, let's see what the market's reaction is. Okay, obviously, again, this line in the sand doesn't necessarily coincide with the previous day's low. It just coincides with the market that tried to sell off. So we could see a real technical sell-off there, real bias, one directional, higher volume, high delta, but prices couldn't go lower. Ultimately, those prices became, or they came underwater as soon as we got above those 38s. And we can see that as soon as we got back above those 38s, 39s, market went quite aggressively back, but up. I'm just going to fast forward this forward a little bit, so we can see a little bit of obviously aggressive buying coming in there, continuation, and obviously a break of the high as we unwind the delta. Remember, obviously, with regards to this trade strategy, we stay in until either the delta is fully unwound or we take out the extreme of the day. Okay, the next strategy we're going to look at is the oil WTI on the 29th of November. And in this example, again, we're now looking at a rotational chart, and again, you can see really how, on a rotation chart, we can really see the momentum and the flow coming into the market, real aggressive volume there, as well as delta and accumulative delta. So this is a substantially large delta on the day. We can see that not just with the number, but also the dark blue. Now again, obviously what we're looking for here is an unwind of this potential delta. We can see that the market reversed very aggressively with the lows and continued in that direction, building a delta. Now, what we're going to do is we're just going to come back a few seconds and we're going to have a look at this line in the sand. Now bear in mind, we obviously spoke about things like single prints and low volume errors. So we can see obviously below these 08s, that was the point where we obviously were just above, for instance, imbalances, as well as single prints lower down. So you would see these single prints on a footprint chart, or on a market profile chart, sorry. But also you can see the imbalances on just a normal chart. So we can see the market comes in, gets below those 08s, and washes out. So it takes out that delta, a very aggressive 2000 unwind of the delta. Note, market goes back bid, and then we continue the process of unwinding the delta. Okay, so again, you obviously can go watch this in its entirety. In terms of the execution, again, we want to be aggressive ahead of the break. We can see that, when the market did get below that low, so note, if I show you on the candlestick, I'm just going to go back fractionally. So as we got to those 08s first time, note, the market extended. 1 second. So the market did extend. Okay, so we can see the market tried to extend, tried to go back bid one last time, and we can see this in the candlestick, formed a little bit of a double bottom, and ultimately once that selling came in, we then got the flush down. So it really did. If we see that dark shade there, we got really 3 dark shades of absorption there. That was the absorption, the opportunity just before the unwind of the delta. Alright guys, that then concludes the video section of this trade strategy. Let's now go and complete the templates. So you now understand obviously why I mentioned that to be a very patient strategy. It does require a lot of early observation. It does require contextual understanding of what a bias implies. But ultimately, once you've grasped this and you've got your line in the sand, it's simply just focusing on when we get back to that red line. And if we do, we simply execute. Obviously now in terms of market context, we spoke a lot about bias, and we spoke about fundamental and technical biases. So do make sure you actually write down what created that bias. In terms of bias, we do observe obviously the delta and the cumulative delta, as well as the price response. Now, do note, trending markets do tend to create a better technical bias. Therefore, you're probably going to see an easier delta unwind when there's a technical drive driven as a result of a trending market. In terms of balanced and imbalanced, again, ideally imbalanced as it manifests strong technical biases. Okay, so an imbalanced market, obviously, it's going to suck in a lot more participants into extremes, therefore creating a much stronger bias and position in the market. Trade location, breakout or trending, we mentioned. We said you can also find in low volume areas as well as initiative drive. So these were all the sort of focus points where potentially you could see a delta unwind. But again, it's not an exhaustive list. It's about you identifying, where did this delta unwind occur? Okay, because over time you're going to have a set of maybe 3 or 4 different lines in the sand that you find work very well. And most importantly, guys, the real crux, and hopefully I've driven this home over the last couple of units, is that you don't have to take all 10 of these strategies. If you take one and adopt it and you execute and you become very successful, then that's my job done. But what's most important, just like with a strategy, is you don't have to have multiple lines in the sand. You might only want to trade the strategy when it gets to one line in the sand, or when there's only one bias in the market, like a fundamental bias. So I've just given you a number of variations. It's up to you to go and explore these variations through the numerous completions of these templates and adopt what makes the most sense to you. In terms of conditioning then, time frame participants, large time frame to create the initial leg for obvious reasons, to create that bias. They need to get everyone into the same position. But then the reversal is created by the speculative algos, and we mentioned the reason why. The initiative, players, the big players, they don't tend to use such tight stops. So the reversal tends to come as a result of the unwind of the shorter time frame positions. In terms of liquidity, high liquidity on the bias phase creates higher cumulative delta. Note, this cements the positional bias. So low liquidity on stop down provides a sharp position unwind lower. Now, in terms of volatility, it'll be high on the stop run with a low level liquidity being provided for obvious reasons. Okay, let's now have a look at the strategy identification. So interaction is quite important. The most important interaction you want to pay attention to is in and around that line in the sand. So that point where the volatility steps up. I think if you really want to get good at the strategy, just always observe the moment that big unwind comes. Go and view what was the key interaction taking place at that point, and you'll very quickly learn some identifiers. Now, in terms of interaction, obviously, we will see initiative in the bias accumulation. Why? Obviously, because that's going to suck in a lot of participants and it'll leave low volume areas and imbalances. In terms of obviously interaction, it will be aggressive on the initial drive where it sucks in the bias, but equally once it's formed the consolidation phase ahead of the line in the sand, once it does begin to unwind again, it will look quite aggressive. Okay, note the line in the sands include, and I gave a couple of examples, and again, just a list. You can always add to this list, subtract, and do whatever works best for you and adds value to your trading. So obviously, previous days high and low, sets of single prints, imbalances and low volume areas, delta pocket positions, starting price of data piece, as well as the 50% of the daily range. Okay, and that tends to work. The 50% does work a lot better within balanced days. In terms of the metrics, we're going to pay attention to obviously volume. Dark blue volume on the trend leg, and then unwind. Again, you're going to see some potentially dark volume when finally the responsive behavior steps in. But again, note the variations in the volume. Where does it come in? Where does it not? In terms of time, obviously short or measured time at the line in the sand. So this is something we spoke about. Sometimes the line in the sand provides a bit of a consolidatory phase before it obviously unwinds the delta. Sometimes it happens very quickly. So again, make sure that you're noting this down, noting down time as a key component. In terms of the delta then, it should accumulate consistently, reflecting this bias. You always want to see the delta in the direction of the bias or the trend. Without this delta, we don't have a delta unwind, so it's imperative there is always a delta to be unwound. Note obviously in terms of the cumulative delta, as prices move higher, we do want to see the delta, the cumulative delta move higher. That just really confirms that bias. Okay, what you don't want to see is as prices move up and down, you see the delta going in a divergent pattern, because then ultimately there isn't necessarily really a bias in the market, or at least a positional bias in the market. Okay, in terms of relative changes on a pullback of a bias move, watch that pullback. Watch the relative shift, watch the dynamic and the interaction. Also note the volume, the delta, the price volatility. It should be relatively low on that pullback. So we'll have that initiative leg. Everything will suddenly almost die down as we move into a bit of sideways mode. And then obviously things speed back up once we take out the delta. So again, note those relative changes. I've been through this enough times with you guys. You look at that summary box, look at the color shift changes, look at the interaction, the volume, etc., etc. Okay, let's turn our attention then to the execution of the unwind of the delta. So obviously in terms of execution, we need to be both passive and aggressive in terms of execution. We can be preemptive, but again, only if we do get that little bit of a signal, which will come in the form of a bit of a consolidatory pattern. If you do get that signal, you can be in early and then add on the break. If not, we just add on the break ahead of the wash down. In terms of risk stop, we're always above the rotational zone. So where that little consolidation zone comes in ahead of the line in the sand, that's kind of where we want our stop. But again, manage this, play with this, always find ways to reduce your stop and ultimately increase your targets. That being said, the target will be a retest of the extreme, an extension of the extreme, a stop down that creates an exhaustive high or low. So whichever one of these three comes first, that will be your signal to take some profits. Bear in mind, as this is a stop down, once it does bounce and find response in the opposite direction, you could see quite an aggressive bounce. Okay, so do be warned, don't leave profits on the table. In terms of risk reward, very, very high. We've got a marginal stop and we've got a target of bigger than 50% of the current range. So really good risk reward metrics. Note in terms of the application, like I said, you can be preemptive and then add on the break. That means we can get quite leveraged on this simply because we can add early. And if we add early, it means we can add onto the break, which gives us a lovely leveraged position to take advantage of the market's impending move. Tip, always know the market positioning. Okay, regardless of whether you like the strategy or not, always know the market positioning. Know which way the short terms are positioned. Know who's driven the positioning. It's always done by the longer time frame big participants. But also know when those short-term positions are about to become unstuck. Okay, the positioning will show the market's short-term bias, so make sure you know what that delta is doing and what large and small delta represents. Okay, let's move on then to our next of our additional reading. Now this book has a story. Most traders that know me on the floor, or that have been around me on the floor before, would know that I used to have a little bit of an emotional streak. I used to verbalize emotion. I used to sometimes show emotion. I used to moan a lot. Generally, I was a nice guy, but I had this emotion. I was giving energy to this emotion. And eventually, I decided I had to do something to stop it. I had to do something, to eradicate this bad habit. And I mean, I tried probably about a year and a half, 2 years ago to try and, get rid of it, tame it, understand it, etc., etc. And it was this book that ultimately got me to get rid of it. Okay, it's from Dale Carnegie. Again, it's one of those self-help books. It's probably, you pick it up, it's a small book, you're probably going to read it and think this was a silly book. Why did I read this? But what's beautiful about it is that it's so silly in that it's simple. Okay, it probably has all the cliches you've ever heard of, but that you've never adopted. And that's what makes it so highly effective, is that it keeps things simple. It brings out some really, really important really strong, effective life lessons, and it does provoke your thoughts and ultimately humble you. So that is the action. You're going to have your thoughts provoked, and you're going to hopefully become far more humbled by this book. And it's titled How to Enjoy Your Life and Job. Again, probably a title that scares you away, but just humor me. Now, in terms of key highlights, it's a simple way to become more grateful. And that's what I was missing. That was the key element I was missing. I've always been a grateful person, but I've never spent enough time, really thinking about, the things that are important in life. Okay. One of the biggest but one of the biggest problems that traders have and pitfalls is that we can become self-absorbed. There's no secret. Everything we do is for ourselves. We're not very good team players. We tend to focus on ourselves, everything we do for ourselves. So it's very natural that we become a little bit selfish and self-absorbed. That being said, we do sometimes forget to self-reflect, to be in our own thoughts and really just be grateful for all the great things that life has outside of trading. Okay, trading, because of the dynamic of it, can make you feel as though it's the most important thing in life. But in actual fact, guess what? Trading is a job like any other. Okay, whether you're serving coffee or working as a receptionist or trading, they're all jobs. They all have various processes and various outcomes. That being said, some of the other key highlights: 7 ways to peace and happiness. Some really good ideas in there. How to win over people. I thought this was incredible. How to really just be on the right side of people rather than the wrong side of people. Topics include things like frustration, fatigue, boredom, excitement, harmony, and using our best resources to realizing our full potential. Definitely consider this book. It really, really changed a crucial part of my career. It will provoke your thoughts, and hopefully it'll have the same kind of impact it did as it had on me. All right, let's wrap up now with Unit 14. Practice makes perfect. This is the second last drill I'm going to provide you with. Make it count. Make it a good one. It's very simple. Go over the drill. Write down your template. You should be very good at these templates now. You should know exactly how to complete these templates. What you should note is note the pattern within you getting quicker at completing these templates. Note also how you're probably adding more and more thoughts to these templates now as I'm going on throughout the units. These are all kinds of things that are very, very positive and showing that you are building a thorough understanding of the template, but also a very good habit. Okay. Once you're done, obviously, with the template from the drill, do go and watch the guided tuition, come back to it, adjust the template, move on to some of the other drills or the other live practical examples we utilized in the unit. Again, complete the template, and when you are confident, you can move on to the final unit of this footprint course, which will be Unit 15. To finish, from the master himself, Paul Tudor Jones, the most important rule is to play great defense, not great offense. Now, we are really like this. If I was to give one key characteristic that every successful trader I've met has, they're all extremely good risk managers. Okay, they all know when to just get out. Whether they're wrong or right, they don't care, they just get out. Okay, that's the sign of a really, really good risk manager, is to play great defense, not offense. Okay, the offensive patterns will come. That's what I'm showing you here. But note how in every strategy, I'm teaching you about offense, offense, offense. Good luck, and I'll see you guys in the final unit, Unit 15. So welcome then guys to Unit 14 Strategy 9. Again, not the picture perfect example I think that most of you are hoping for. So again, just like we did in one of the previous units, I wanted to give you a slightly different variation of the delta unwind. Now, the first thing to interpret is that let's just look at the market context. So we can see the market sold off quite aggressively in the oil. We sold off all the way down from 56.30s all the way down to sort of 55.96. So technically speaking, we've captured a little bit of a short positioning in the market technically, okay? We know that not just because of price, but we also know it because of where the trade location was holding. So it's sold off and we've begun this process of sideways trading. Now, the only thing that doesn't really kind of work together with this delta position unwind is that we actually have got quite a positive delta on the day. So you can see down below the delta is positive 4,650. So if we were going to see a delta unwind, we wouldn't want to ideally be seeing it to the upside, but rather to the downside. Now, that being said, however, sometimes you do get delta unwinds that are within the range. So a lot of the time the delta unwinds, the market will extend maybe all the way to the low, capture some short positions, or to the high and capture some long positions. Slowly but surely we start to reverse to that line in the sand area that we spoke about, and once we get above or below that line in the sand, we unwind quite aggressively. Now, in the example I'm going to show you, we do have a line in the sand. Okay, if we were to draw some sort of a trend line, we could very clearly see that line in the sand comes in around about that 56.15 area. So let's watch what happens and let's see how the market responds. Now, the first thing to note is that we're likely to get some rush to the upside, okay? Not necessarily a delta unwind. Why? Because we obviously still have a very positive delta in the market. So straight away, we can see that the market does, however, once it gets above this 15s, note the reaction, and this is why this is quite an interesting example. We do get quite a surge in volume, so a pickup in the volume and a pickup in the delta, which suggests to us that there are actually positions stopping up there. Okay, there might not be short positions in a delta sense, okay, but there definitely are short positions. As we can see the market getting above those 16s, we get a volume surge. Now, this is crucial because a lot of the time we assume that a cumulative delta means positioning. In other words, we assume that because the market has a positive 5,309 delta, that the position is long. Okay, it isn't always the case. Remember, a lot of the time, particularly over roll events or big fundamental events, the delta can be skewed. Okay, so delta does not always equal market positioning. It's a rough indication, but it's not a perfect example of market positioning. So just bear that in mind when you do your analysis. Okay, now obviously the market then rotates a little bit, and I just want to talk about, we get this little bit of a two-way trade here. We can see the market holding up quite nicely now, and all of a sudden we get, let's just move this back one frame. So all of a sudden the market comes in, obviously we see quite a bit of absorption at the low, a little bit of a negative delta, nothing really going on in terms of volume, so we can see no real changes in volume, and suddenly the market just goes very aggressively bid towards the upside. Okay, so the chart's back, and note we suddenly see the market go quite aggressively bid up. So straight away, I just want to pause it there. Now again, how do we know this is a delta unwind, or how do we know this is a position unwind? Okay, it's very simple. One, it's occurring in the middle of the range, and two, look at the structure of the footprint. Okay, a lot of imbalances, a lot of zeros all over the show, and a very aggressive snap higher on higher volume and higher delta. So in essence, still a very good example of an unwind of the positioning in the market. It's just not necessarily an unwind in a typical sense where we have a negative delta. In this example would have been more picture perfect for us. Okay, so I'm just going to play that through. Obviously, the market does then continue the process of stopping out, unwinding all those positions once we get beyond that line in the sand.
Okay guys, very basic example, very simple example, of stops occurring in the middle of the range. Do go and have a look at that, play that through again. Remember, delta unwind, sometimes it is going to be picture perfect and it is going to unwind the delta that is there, but sometimes the delta can be also a little bit confusing, so just make sure that you understand the difference. That's then a wrap of Unit 14, drill for Unit 14, Strategy 9. We've got one more drill session to go. If you want another example of this, obviously you have got the practical examples down below. Good luck. I'll see you again in Unit 15.